Hey, you guys, Dev here at WeBuyHouses.com. Welcome to the Cash Offer Masterclass, episode number 60. Guys, today I have a special guest. It's Ray Williamson from Kiavi. Kiavi is a private lender that probably maybe one of the biggest in the United States that works with real estate investors. And Ray's going to be our subject matter expert today on lending, how investors fund their deals. And so with that, I'll just say, hey Ray, how you doing, buddy?
Doing awesome. Really appreciate the invitation.
Well, it's good to see you here. Ray and I've known each other for a little while, and a lot of the WeBuyHouses.com licensees in our system work with Kiavi. Like once you get to a certain level, you need access to real money from real professionals. And so that's where they step in, and they really can scale and fund any deal almost anywhere. I know you guys are, there's probably states you can't do it, but we'll talk about that here.
Yep.
In fact, I'm going to go ahead, Ray, and put up our slides for today, kind of
All
give
right.
us, remind us what we're going to talk about.
Yeah.
And the first step would be just to tell us a little bit about you, a little bit about Kiavi, however you would like to introduce yourself to the group today.
Yeah. I've been, at Kiavi for 11 years. I've been in the mortgage business since 1989. I think some of the kind of benefit that I can provide on behalf of the company is that I helped kind of build out our operational kind of team and process back in the early days when I first joined the company, and then transitioned into sales for the kind of last 8.5 years, if you will. And so one of the things that we identified, whether it was Kiavi or not, was just an opportunity to um, allow for financing to take place at a more institutional level in this space. Whereas when you go back to like 2010 or further back, really I'm 61, so I can say this. It seemed like the industry was three 70-year-old men in a conference room giving a thumbs up or a thumbs down, and so it really lacked consistency,
Hmm.
reliability, et cetera. You just didn't know which direction to go in, and so I think there was an opportunity to bring more institutional um, efficiency to the space, and I think there are a lot of lenders that are doing that. We're just one of them.
Yeah, yeah. Well, you are definitely one of the biggest that I'm aware of. And I was looking just at the stats I pulled off your site. 27 plus billion dollars is a lot of lending over the years. And it looks like you guys are in most states, right? You're able to work in most states.
Yeah, we're in every state but four now. New Mexico and Rhode Island are the next two up, and so we will actually only be not in three or two once that's done. So Utah is still being worked through, if you will. Vermont is still being worked through, but New Mexico and Rhode Island are sort of next up and probably a month away.
Oh, well, good, good. It's continuing to grow.
Yeah.
Yeah, one thing that you guys in the audience would find as you start to deal with private lenders is many of them do not have that level of scale. They may work in one state or a few states, and it's kind of rare to find a company like Kiavi that for us, you're a good partner for us because we cover so many states, and
Yep.
it's hard to recommend somebody that works in three states.
Yeah.
Right.
Unless you're in one of those three.
Yeah, unless you are. Right, right. Well, that's who you are, and who we're going to talk a little bit more about Kiabi, obviously, as we kind of roll through it.
Sure.
And Ray, I just wanted to use your expertise, you as the subject matter expert, to kind of help us think about how people fund, how real estate investors fund their deals, and
Yep.
it really goes from everything from just using your own money to
Right.
do buy you a rental house or whatever,
Right.
and then maybe building that up, a small portfolio with conventional mortgages or things like that. But kind of tell us what do you think about this? I think of this almost as a pathway to Kiavi, but what comments do you have about these various ways that real estate investors fund their deals?
Yeah, I think that's a great question because I think many investors, whether they're doing, 50, 100 plus, started out probably either with number one, number three, or number four, right? They've
Hmm.
either started out with their own money, they went to their friends and family where they had a great idea, or maybe they were connected with some local folks. You referenced doctors, lawyers. It just really could be anybody with wealth that wanted to deploy that wealth or that capital differently in a way that was going to generate them, greater returns. Right. We spent a long time, other than probably the last maybe 2 years, people were sitting with money in the bank. It was stagnant. It was earning less than 1%. And when people look to invest in real estate, sometimes it's not on their own, but if they can do it, you referenced passively, right, through
Hmm.
somebody that they trust, an operator
Right.
that is either maybe doing their own deal or they have a trust in doing other things in real estate. It might be their first or second deal. There's definitely some folks that always start out with their own money. There's nothing wrong with that, right? Because the logic when I'm talking with people, even if they're doing several deals per year and they're still using their own cash, I think the biggest reluctancy is paying money for a service that they could avoid paying for if they use their own money. And on the surface, that sounds completely normal until they need more money than what they have. Right. So they're either looking, because typically, unless you're Warren Buffett, it's very difficult to scale a business with your own cash. And at some point, you need to use other people's money, regardless of the endeavor. We're obviously talking about real estate here. So the first step is to what you're doing is, well, instead of using my own money, I'm going to get a personal mortgage, which sounds extremely logical. Hey, I got a house, I have a mortgage on my primary residence. Why would I not just go to my bank and borrow money on that and pay that interest? There's going to be fees and a process, et cetera. There's nothing wrong with that thought process. I think it all comes down to education, which is one of the things that We Buy Houses really provides to their team is, hey, there's 6 ways here to do it. It might not necessarily be here's the route that might be best for you, and it might be five or six or two.
Hmm.
Um, but not necessarily speaking to all these things. Um, the conventional mortgage route might be the right route because maybe the interest rate might be lower, but there might be a significantly larger down payment on that particular property. And you're wanting a bank, and typical conventional mortgage isn't going to provide funds that will both handle the acquisition of the property and the rehab that would be needed,
Hmm.
right? Whether somebody's buying a property just simply for acquisition, rehab it to resell, but a lot of times folks are buying a property to rehab to retain. And so sometimes getting the rehab reimbursed prior to refinancing out into better terms is a better scenario. Also, if you're taking out a mortgage, a personal mortgage, typically you're doing it under your own name. And if you're looking to, if that's I'm just looking to do it once, want to see what it was like,
Yeah.
might be the best route. But if you're looking to build a business, being able to shield liability from your personal assets to a business, kind of a just in case, is a step that a lot of entrepreneurs take. And typically, the conventional route is not going to provide financing to an S corporation, a C corporation, an LLC, et cetera. So you start to eliminate the conventional mortgage route from being an option from that. If you're really truly looking to kind of build and scale.
Yeah. On that, you and I were talking earlier about in episode 50 when I had Joel Beal on.
Yeah,
One of the things that Joel said to the audience was, "Don't use your own money,"
yeah,
that's what kind of made me think about inviting you. And hey, Ray and I should talk to people about how you don't use your own money.
right.
Yeah.
Yeah, I mean, the phrase that a lot of people use is leverage your cash. right? The people that use cash, one of the things I'll ask them is, you know, why has that been the path that you've chosen? And a lot of times, and I think your group will appreciate this, is having a lot of cash or having cash in the bank is like a warm hug, right? It just makes you feel better when you wake up, when you're operating, et cetera. But at some point, when you deploy a significant amount of that, whether it's all acquisition or all acquisition and rehab, and then another deal might come up, you have the money and you do it again, all of a sudden you look in your bank account and it's sparse. And I
Mhm.
think it's human nature. This is how I am. If my checking account, not my savings and other, but when my checking account goes below a certain level, it's, you start I start to get a little bit nervous,
Sure.
kind of because just if a just in case moment comes up, et cetera. So being able to leverage other people's money. So the decision has to come down of, I'm going to pay for this um, decision. You're going to pay through it through interest rate. You're going to pay through it through, kind of points and fees, whatever that lender is going to charge. And then you just simply spreadsheet that out. And so what it really means is, okay, if I'm going to charge this money, I need to probably buy this property at a deeper level, or I need to have the knowledge from my appraiser network or my realtor network that the exit price is going to generate the additional profit that's over and above what that cost is going to be. Right?
Mhm.
There's only two places to make up cost: buying something cheaper, selling something higher. Like it really can't be configured any other way.
Yeah, yeah, yeah. Um, I, you know, the folks that join WeBuyHouses.com, many of our we appeal to established real estate investors. They've already
Yep.
got a business. They've been doing this for a while.
Yep.
And so they're no longer, talking about mortgages or self-directed IRAs or borrowing from their family or whatever. These people have all kind of moved into these lower levels.
Sure.
And some, like I've seen over the years, they'll have a great relationship with a bank, and the bank provides them good terms and has worked with them for so long that they understand their business model, and
Yep.
they know that they're good for it, where that might be a little more challenging, to just walk into a bank and say, hey, I want to I want to buy and rehab a house, will you give me a loan for that?
Right.
But if they've been doing it for a while, and let's say they had five or six mortgages for rentals, and they end up going to a bank saying, hey, I just want to do a single loan,
Right.
pay off these mortgages. Or, the other thing I didn't put on my list, Ray, you may have some awareness of, is the idea of buying houses subject to the existing mortgage.
Yep.
And this is kind of a gray area in funding, to be honest, because
Right.
if I buy someone's house and they let me take over their mortgage,
Right.
that's not really copacetic with the mortgage company. In fact, usually the mortgage company may not even be aware.
Right.
Now, if I start paying that mortgage and I keep it current, the mortgage company is probably not going to care because
Right.
somebody's paying it,
Correct.
and they're keeping it current. But I knew a guy. In fact, I'm going to do a profile on him in the future. This guy, Mike Anderson. He's in his 70s in Tucson, Arizona.
Right.
He is a titan in our business. Thousands of properties this guy has bought. But in the early days, he started his business subject to, like he would
Right.
buy houses subject to. He
Right.
ended up with quite a few of them. He went to his bank. He said, "This is what I got. Here's my
Right.
cash flows, blah,
Right.
blah, blah. I need to replace these loans." And so they saw his cash flow, they saw his performance, they saw his history. And then, next thing you know, he paid off all those loans on the subject to properties, and fully controlled and possessed those properties and the liabilities associated with them. So
Yep.
I've seen some crazy ways to get to scale. And sometimes I'll see at the end of that, there are banks that will work with investors, but it seems like the cases I've seen that work, they had to really show a history of doing it
Right.
and cash flow and making money, because local banks really aren't. It'd be my assumption they're not. comfortable with the level of risk that might be associated with investment real estate.
Yeah, I would say that the time that we have here, we could absolutely spend only on uh, it's called either seller financing, owner financing, or subject to financing,
Hmm.
because what sometimes the premise from I would say novice or outside investors is, people always want to sell a house because they want to get the capital back so they can redeploy. Well, sometimes what ends up happening if you sell a property is a tax event, right? So you're going to have to pay some type of capital gains, and maybe that isn't in your best interest to do that. So if you sell a property subject to the existing mortgage, and it happens to be an attractive mortgage, right? If you refinanced in either 2000, 2001, or early 2000 or 2022, you probably have that. And so what people are looking for is cash flow. So sometimes you might give them a little bit of earnest money for the right to take over that mortgage. You give them a note, right, for that difference or for that sales price, and essentially you're giving the owner of that property now cash flow, and you have that property at a lower interest rate that you can eventually do something with. So now that person gets to have cash flow. They have a little bit of earnest money. They're essentially pushing out the tax event
Hmm.
for both people, et cetera. So it's not like on this list, nothing is always like the perfect example. There's a great example to use your own money. There's a good, probably fewer reasons to have a personal mortgage, but the rest of these items all have their place. Like friends and family typically aren't going to establish an underwriting criteria for you,
Right.
right? And
Exactly.
so they might be able to wire you money in an hour, whereas other like a bank or a credit union, they want to dot the I, cross the T, as well as some private lenders, et cetera. So there's
Yeah.
always going to be, as long as you understand the playbook, right? So I always use a sports analogy. If you understand the playbook of a particular sport, you could probably play the sport at a much higher level than if you did not. It's
Hmm.
the same thing with real
Right.
estate.
Yep. Yep. Um, well, cool. So the other thing I was going to mention to you that because I've been thinking about what's been working lately.
Yep.
This year, I went and visited our two largest clients. They're in Birmingham, Alabama, and Memphis, Tennessee.
All right.
And both these operations right now, they sell their end product to a passive investor.
Got it.
And so this could be a doctor or a lawyer in California that
Yep.
can't find a deal there, but in Memphis, they can get a like a 1% rule type deal,
Yep.
where reasonable investment and very good cash flow
Yep.
and that whole 9 yards. The thing that I was amazed about, Ray, is they go find a deal and they have an like they got a pipeline of passive investors who
Right.
want these deals.
Yep.
They go find a deal. They shop it to the investors. One investor says, I want it.
Yep.
That investor is providing the funding that for the acquisition and renovation of the property
Wow.
from beginning, like cradle to grave.
Got it.
I was really amazed by that because I realized, well, you have infinite scale if you never have to come up with the
Yep.
money.
Right.
But
Yeah.
but then of course they're creating a product, and that
Sure.
product is the managed passive investment that
Yep.
is going to cash flow for the next unknown number of years or whatever.
Yep.
But just I've seen that model doing really well this year. And of
Right.
course, the model that's not doing as well in 2025 is the, sell to the retail buyer model. When, a lot of these projects, I'm seeing guys end up holding properties longer than they thought they would,
Yep.
having to sell them for less than they hoped. And so you got longer holding time and a
Right.
lower exit price so that you're, really is compressing profits for some of the folks that have the traditional model. But
Yep.
anyway, it's all about money. I mean, ultimately, we're buying and selling and fixing houses, but it's it's a financial exercise.
Correct.
It's all about the money. And at the end of the day, whether you've got positive cash flow and profit, at
Right.
the end. But let's jump into this discussion. So we kind of talked about all the ways that people might be funding their deals, and I
Sure.
kind of want to. Well, I'm just thinking about what is it? What is Kiavi? Who does it appeal to, and why? What are the advantages of it?
Yeah, good question. So I think understanding, I guess, what Kiavi is. So there's several institutional what's almost considered you labeled it as a private lender. More than likely, if somebody's going to Google it or find out that private lending and hard money lending tend to be synonymous.
Right.
The downside is a private lender sounds smoother, right? Whereas a hard money lender sounds like harsh and that it's loan sharking, et cetera, which was my kind of description earlier of the three men in a conference room. I think that changed starting in 2010 of being able to bring more consistent, reliable, and when I say institutional, it's actually less expensive financing to the operators that are acquiring these properties. So they're able to bring in less money to close. The interest rates are lower, right? Back in the day, it used to be 12 to 15%. You're still putting 20% down. You're paying 4 to 5 points, et cetera. That's loan sharking. And so that is not hard money lending these days. So what Kiavi really tried to do is who's the avatar that we were going after? And initially, it was folks that were doing this as a side hustle, right? So if you have a W-2 job and you're interested in getting into investing, when are you going to be spending your time doing that? Well, probably before 9 a.m. and after 6. And so typically when is a lender open for business? 9 a.m. to 5 p.m. So there was always going to be a conflict with the operator's time and available to really engage and the lender's time of being available, right? And so what we built was a platform that enabled an operator to do business with us on their time. The phrase that I sometimes use
Interesting.
with people is if you hate human contact, you could actually facilitate every single scenario with us from initial upload, financing the property, getting a payoff, getting a draw, et cetera, without actually ever talking with a human being. Right now,
Yeah.
we don't have no human beings as the account manager, but we wanted to facilitate the platform to enable that so that somebody could work after hours, before hours, and then during hours. So that was one part that we saw was a huge miss. The other piece was just the sheer efficiency. You'd have stories of people going, I bought a property on this street. I took it to a lender. They financed it. I took a property that was almost the exact same property and I got way different terms. And so there wasn't any consistency around that. So it was the two different people looking at
Right.
something
Yeah.
differently and coming to a different outcome. So there was a need for the space to build more reliability and consistency around what you'll be able to provide. So that was an endeavor that we had as well. And I think a lot of lenders have that, right? You're asking the difference from a Kiavi standpoint. I think using the data that we accumulate, you mentioned on the first slide, we've done over 100,000 transactions ourselves. We've funded over $27 billion. We're by far the largest. We're the 800-pound gorilla in the space, and so, but that shouldn't impress anybody. What what people should take from that is because our performance is so good, and because the volume is so high. Think about if you were doing anything in life if people were giving out money to borrow and you are the largest producer at the best performance, you're probably going to get better terms. And so by getting better terms from Wall Street companies, we're able to pass that along to operators at a significantly lower cost structure so that they benefit from our size. That's all somebody should care about. How am I going to benefit from you.
Yeah.
Right. And so that's what we're trying to pass along. And when you've done over 100,000 deals, it didn't take 100,000 to get there, but we're able to see data. Right. So the United right now, it's just a big with AI, et cetera. You're always hearing about different things about how AI can very quickly show trends. And so what we were able to do back in the initial days is we asked for probably everything almost except for your firstborn, right? So you're gathering information to see how does having all of this information about an operator benefit us from a performance standpoint. And then you're able to do these testing to see, did this matter? Is this moving the needle on performance? And what we started to find were there were two things, believe it or not, and only two things that drove better performance. One was credit, like a credit score, a FICO score, if you will. So
Mhm.
we do a soft review on credit twice a year because it's a good proxy for someone's willingness and ability to repay their other debtors, their other creditors.
Right.
And then experience. That should not come as a surprise to anybody. The more experienced somebody is, the better they happen to perform. Well, we were able to draw the line at what is that point where performance gets way better and then it really is negligible relative to the performance. So we've been able to identify those two things. It wasn't more reserves. It wasn't looking at income. It wasn't the state that they were in. It really was experience and credit. So it was really cool to see us peel back qualifications to only those two areas and be able to consistently communicate going, if you're at this level, here's the cost structure. And if you're at this level or above, here's the cost structure. So it's
Yeah.
very easy to almost see like, oh, I'm this far away from getting like that improvement. It's just like if you went to a Verizon or you went somewhere else, at some point, if you're a frequent flyer, if you will, right, whether it's at a store or an airlines, you're eventually going to get better like upgrades and scenarios. And we've been able to delineate that point for operators. And I think that makes, from a consistency standpoint, it a bit easier for operators to know what they're going to get every single time and when.
Yeah. Yeah. That excellent explanation because that it really hit on speed and consistency that you guys have gotten because you've done it so much.
Right.
Yeah, that's very, very interesting. Let's talk a little bit about when people, because we were speaking, you were speaking earlier, kind of about the term hard money, which I believe just really means it's associated with a hard asset,
Yeah.
not that it's hard to get.
Yeah, it's almost the easiest, right? It's almost the
It's
it's easier
pretty
money to
easy
get
money.
than bank money. I can tell you that.
But what are the let's just kind of talk real quickly, and I don't know if this is a good way to break it down, but the types of loans that there are.
Right. So when you're looking at, so we're exclusively a residential lender. There are lenders out there that exclusively do residential, and then there are lenders out there that do both residential and commercial. And so when you get into commercial, you start to get into more definitions, right? The easiest definition from what I'm talking about is residential properties are defined as single family homes, 2, 3, and 4 families, condominiums, and like PUDs. That's the standard residential. As soon as you get into 5+ units, like an apartment building plus, that's commercial by the easiest definition. So we don't do that. You start getting the harder definition of commercial. It could be mixed use. It could be the property where there's retail space on the bottom, maybe living space above. Could be industrial, right? An industrial building where you're getting into office space. It could be public storage. All of that sort of fits under that category of commercial, which we don't do. So from a residential standpoint, there's much more consistency in understanding a residential asset, single family home, 2, 3, and 4 family, from a Wall Street perspective. All Wall Street is looking for is consistency and a known entity. They understand that when they start getting into other types, it's more difficult to use an industrial space to a public storage space to a retail space and proxy the risk unless you have enough properties in that particular space to do that, because that's all Wall Street is looking for, is how do we mitigate our risk by investing in these companies who are investing in these real estate assets. So yes, hard money is the piece. So the fix and flip is just essentially a short-term residential loan. So consider like the fix, acquisition and rehab, and the flip is flip it into a resale, or you flip it into refinancing into the long-term debt. So the flip doesn't necessarily always imply a sale. It
Hmm.
really implies an exit
Right.
into sale or refinance. Um, so that's kind of what the fix and flip or bridge loans are. They're just short-term, typically no prepayment penalty loans that allow somebody to, over a short period of time, acquire an asset, hold that asset while they're rehabbing it, and then figure out the exit strategy, what either through sale or refinance. And then the debt service coverage ratio, or the DSCR loan, is a fancy term to say it's a rental property, right? So the reason why it's a debt service coverage ratio loan is these loans don't require or involve evaluating an operator's income, personal or corporate, or their assets, personal or corporate. So typically what this allows us to do is finance a property in an LLC or an S Corp versus a personal name. It allows for any limit of properties to be financed. Typically, if you go down a conventional route where you're using your income and your assets, you're capped at a certain number of properties that you can own and have financed. There is no limit here. Um, it defaults completely to really two factors. One, is the property cash flow positive based on what the appraiser says the rent is from the market, right? So if you're renting a property that would rent for $2,000 a month, they use that in the calculation for that ratio. And then they use the credit score to determine, okay, if you're a higher credit score, you're going to have a lower interest rate, which is common for conventional tiering, if you will. And if you have a lower credit score, you're going to have a slightly higher rate. So all these lenders or Wall Street companies are doing is they're mitigating their risk because they feel a lower loan to value mitigates their risk, because who's going to walk away from a property with a lot of equity? Very few.
Right. Right.
And somebody that has higher credit, they typically protect themselves from going into default better than somebody who has a lower credit score, right? Regardless of how the credit score is determined. I've seen perfect pay history in somebody who has a 680, and I've seen a couple of lates with somebody who has a 770. So sometimes you can't necessarily just look at one particular element, but Wall Street really looks at credit scoring as really a proxy for that ability and willingness to repay. And then new construction is just what it is. Hey, I have a plot of land. I'm going to entitle it, bring electricity and sewer into the property. I'm going to build new. You were referencing earlier, hey, if I had a plot of land and it's going to cost me $60 a square foot, can't do it. But if the market is 150, 175, and you're going to be able to sell it for 225, 250 a square foot, that makes more sense. So you would build that property yourself. The benefit of that obviously is the plans. You're not getting into a rehab of a property going, oh my gosh, there's more behind these walls than I figured. On new construction,
Right.
there's no walls, right? You're just building
Hmm.
new. So there's a lot less typically changes in budget than you might have on a rehab. So that's where the kind of the new construction comes in. Whether you're building a new house on land, or you're building a new house because you have maybe a dilapidated property that you're going to tear down, use the same existing pad and build new.
Yep. 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 Excellent. Excellent. All right. Well, let's see, kind of the final, next to the final slide. How do people work with Kiavi? So folks that'll be watching this saying, I could see myself either now or getting to the point where it makes sense for me to work with a hard money or private lender.
Yeah.
Um, where do they need to be? How do they qualify? Kind of what interest rates or other terms might they be seeing if they're doing a fix and flip or
Right.
DSCR type loan? How do they work with you guys?
Yeah. So from a qualification standpoint, we're really only looking at, I guess, three. One of which is you have to have um, an LLC or an S corp. Like we don't lend to individuals. Um, so that's the easy part because you can
Okay.
go, form one tomorrow. But like I had indicated earlier, we have two criteria: experience. Zero is okay. It's just that if you have zero experience really with any lender, you're probably not going to get the best terms that they provide to everybody, right? And so every lender is probably going to have a different set of rates or terms for somebody who's done maybe zero, one, or two flips. That might be, let's call it 11 to 12% range. There's going to be some points, whether it's 2 to 2.5, et cetera. Whereas when somebody starts to become more experienced, not necessarily with us as a lender, but just in the last couple of years, we can see that their experience depth is good and deep. Let's say they've done 3 or 4 flips over the last couple of years, maybe even 5. They're going to qualify at, almost 200 basis points lower, right? So they're going to possibly be in the 9.5 to 10.5 range with 10% down, as opposed to that 11 to 12% range, because their experience is dictating that. And then the other element is credit score. Different lenders have different qualifications. We require a 660 minimum credit score. Some require lower, some require slightly higher. I think reaching out to a particular lender is always a good idea to get their playbook and then see if you can play within that playbook. But typically, most hard money lenders, even with no experience, are going to provide financing at 10 to 15% down to start. And that might incrementally get better at 10% down. And then if they really have a high credit score and they're doing a lot of business, it might end up reducing that 10% down even further.
Is it a is it a red flag if someone says, "Can you fund the whole thing?"
It's not a red flag. I think it's a common question,
Yeah.
right? And so I think the questions need to be understood of, here's what it means, right? So zero down financing certainly allows for the capital that you have to be more strategically deployed, right? So instead of down payment, waiting 6 to 7 months for the rehab to be done and then the property to be exited through either resale or refinance, it allows for somebody to acquire more properties. It's going to be a higher price, right? So the less money you're putting down, the higher your interest rate's going to be, right? Sometimes what I put back to somebody is, if you were lending your money to somebody and they had none of their own money into it, that's a higher risk to you. You may still
Yeah.
do it, but you're going to charge them appropriately. If they're putting more money into
Good
it, your
point.
risk is mitigated. So you're probably going to have to charge less money to even get the opportunity at that particular property, right? So the same thing applies whether they're doing it on their own with somebody or we're doing it to an operator. But I don't think that I think it's a common question to go, can I do any transaction with as little money out of pocket as I can be? And so the issue really comes down to is, there's a couple of things. One is making sure that you understand what that means, right? So zero down doesn't, at some point, you're going to have to sort of pay the piper, as they say. So when you sell the property, right, you're going to probably have to take into consideration, I'm going to have to sell it for more, because everybody has a margin that they want to make on a particular property. And there's going to be maybe a higher interest rate, higher points, maybe a combination of the two, et cetera. And so you're going to have to calculate that in. Is there going to be higher, closing costs on that? The other thing is, if you have more skin in the game, you might be more willing to, you brought it up earlier, maybe taking a little bit less to get out of the deal to go somewhere else. Well, if you don't have any money into the deal, you might be less apt to do that. And if you have a higher loan to value, right, you have no skin in the game, then your exit options, resale, refinance, might be fewer because you have a tighter equity position. And so having
Yeah.
a down payment in it might actually give you more options for when you exit. Until, if you're a guy that's doing 5, 6, 10 a year, you probably have a model that is not a big deal. Whereas if you're on your first or second one, then, and you don't understand having multiple exit strategies, then there's that feeling of like, why didn't the lender warn me? Right? You should have known that I was going to come up against this, et cetera. And so I think understanding the end game first. It's like when Stephen Covey said, understand it start with the end in mind, and then you work backwards. I think that's what the conversation needs to be, which is, what do you feel the exit price is going to be? Just so you know, as a lender, we're going to validate that after repair value. We might not agree with you and the reason is we're using real data. We're not using what your neighbor feels that property will sell for. We're actually going into what is actually sold in that area that is similar in size, condition, location, et cetera, to that particular property, not taking into consideration any potential equity growth during the time that you might be rehabbing. Right. And so those are the things that lenders do to protect themselves from an operator getting over leveraged, right? And what happens if the rehab budget isn't $25,000 and it ends up being 35 or 40? Then all of a sudden your equity position goes down, especially if you have very little money into the deal.
Yeah,
So
yeah.
some lenders might be reluctant to do it just because it's too easy to throw the keys at the lender, right? Because they just don't have any financial interest in the property anymore.
How does someone work with Kiavi?
Certainly they can go to the website. Our portal is very interactive. So if they have a property, they just wanted to kick the tires to go, I wonder how financing a property would be at $200,000, putting 50K in. They can go do that. They can certainly reach out directly to anybody here, including myself, just to kind of talk through things. Obviously, my team tends to work more with experienced folks, but we have a team that works just with folks that have not done a deal yet, right? So that they can feel more comfortable with talking through some things. Hey, what should I be looking for, et cetera. So we handle kind of both sides of the fence.
For the most part, are you are you looking to work with people who have done 6 deals or 10 deals or something before they come to Kiavi? Or because you just said you actually have people that, as long as you have, I guess, credit, because you talked about credit and experience, and I'm kind of
Right.
thinking about this. There could be somebody that comes to you, got great credit, they got 250, $500,000 of
Yep.
liquid capital, and but obviously they can't buy a whole bunch of houses
Right.
for that. But they, if they leveraged that,
Yeah.
So do you guys, you mentioned it, so I guess that's my question. You work with people who are, they got good money, good credit, but they're new to the game
Yeah.
versus those who have 6 to 10 deals under their
Yeah.
belt.
Yeah. So I would say we have essentially two teams, right? Well, I'll call it the experience group. I'm on that. So it's the people that are probably earnestly doing at a minimum 3 flips a year, right? And so
Minimum, yeah.
whether that's with institutional money, their own cash, et cetera. So they're really looking to, how can I improve terms? How can I leverage my cash? Right. I'm going to graduate from either a private person, because private people are great, but they're tapped out. Not every private person has 500,000 or $1 million that they can give exclusively to you. Right. Whereas we fund over, like last month, we funded over $700 million. Right.
Wow.
So we don't run out of money. And so that's an advantage of going to an institutional lender, because they're not going to run out of money like a dentist or a doctor might. Both are great, but they're going to be used differently. Right. And I think diversification of capital is critical, so that you can have, I got a good bank, I got a good institutional lender, and I've got a couple private people on kind of a just in case, right, that I need to move even more quickly than maybe one of those two other people can do. So I think, does every lender want 100% of your business? Most would say I would like it, but my contention is there should be diversification of capital so that you have a go-to in a couple of instances, so that your business is smooth, as opposed to having be disruptive, of being forced to go somewhere else when you didn't have a relationship to begin with.
Yeah, yeah. All right, Ray, I've got just a couple of questions to ask you. Well, I guess it's just one question, but a couple of dimensions. I like as we end 2025, we head into 2026. What do you see on the horizon for residential real estate investing, as far as interest rates or values or cost of renovation, or what are your thoughts going into 2026? What should their mindset be?
Yeah, I mean, if you're, I would definitely, if you're not, look at the, you know, 10-year interest rate, look at um, read, whether it's, John Burns or just really anything that is particular to financing, economics. It's if you're earnestly interested in the market, right? Because there's a lot of pressure on interest rates conventionally. And so there was, and I think understanding that the Fed interest rates are different from conventional interest rates. So a lot of times the undereducated might think the Federal Reserve just lowered interest rates. Why haven't my bank or my lender lowered theirs? Because they are not one and the same, right? The Fed rate affects banks borrowing from themselves. So it's going to be significantly lower than the borrowing rate that a bank can offer, a wholesale lender can offer, or a hard money lender, a private lender like a Kiavi. And so, but what really drives interest rates to either go up or down is, inflation, economic feel, unemployment. Just because prices are out of reach doesn't mean that conventional lenders are going to make rates lower so that more people can afford them, right? And so I was in the business in 2005, 6, and 7 when it went off the cliff because there was an oversaturation of inventory. Interest rates were at an all-time low.
Right.
Credit criteria was at an all-time low, right? It was like almost too easy to get a mortgage, and more people were buying more properties than they should. They thought it was going to be this endless route of property values going up, whereas right now, property values, even though they feel unattainable, they are coming down a little bit, and it really depends on the market. Texas and some other states are probably feeling way more stable than others because you have infrastructure, you have more businesses that are coming in. Texas is a very business friendly state. You guys take so many businesses from California, it's not funny. And so,
Now New York.
right, and so whereas California cost of living where I live is very high. But you probably don't come to California for the cost of living. You come for other reasons. If you can afford
Mhm.
it, great. If you
Right.
can't, you're probably going to leave. And we've been here since '91, so we feel like we got in before the stuff happened. But I think interest rates, for the most part, unemployment would have to go up. Right now, it's in that 4.5 range, approaching 5. It's probably going to have to go well above 5 to 6 before you would see any type of conventional interest rate movement on the down. I'm talking about significant movement down.
Yeah.
So my anticipation is through at least March or April that interest rates on the conventional side are going to be probably fairly stable. It doesn't mean they won't go down an eighth or a quarter. I don't anticipate them going down 50 to 75 basis points without some catastrophic unemployment or inflationary uh, event taking place, even though there's a there's a sentiment for it, right? I think values probably have to start, creeping down slightly. Inventory is eventually going to come in because there's just no inventory, and so you can't have home prices fall when there's no inventory for people to buy,
Yeah. Right.
right? And so I think builders are starting to build more, but they're not building at the scale that they used to, right? So instead of thousands, it's hundreds. And so that will incrementally start flooding the market over the next probably 36 months. But I think people that in our space, right, people that are rehabbers, people that are rehabbing and they're going into new construction, those are going to be the folks that are really going to provide the inventory that these buyers want. First time home buyers probably not going to be that big of an issue. What I'm seeing is I'll categorize buyers in 3 categories. First time home buyer, and the market obviously is important because a first time home buyer in San Diego might be different from one in Dallas, different from one in Jacksonville, Florida, et cetera. But it's just in the categories. First time home buyer market seems to be very stable. right? You're looking for a good home. You're looking for um, uh, you're basically looking for like a safety, right? It's just a house. And so it's the move up buyer to that next home. That is the market that is very stagnant, right? So
Right, right.
whatever
Yeah.
that price point is. Now, the larger move up buyer, maybe instead of your second home, your third home, not third home that you own, but the third home that you've bought, like those people, they worry less about income and assets, worry less about payment. So that market is actually pretty strong. So the two strong markets are first time home buyers and the ones that are over a certain threshold. So in most markets, it's probably 400K below, good. 400 to 750, tough. 750 plus, not tough because they've got the cash, they've got resources to handle that. It's the middle market. Now, how I just described that might be the Texas market or the Florida market. Some state like in Boston, that might be a higher price point, right? Or in Northern Virginia. In California, it might be a different price point, but you kind of get what I'm talking about.
I mapped it exactly. Like as you said the numbers, I was yeah, here it's 300 to 500 is the tough zone. Like
Yep,
the $1 million houses north of Dallas, those things sell for cash.
yep, yeah.
Those
Yeah,
guys
because
aren't worried
people have
about rates.
resources. They have
Yeah.
different resources to be able to handle that, whether it's
Yeah.
sale of assets, cash that they already have, they're making a bundle of money, et cetera. It's the tweeners
Now,
for sure.
Ray, it seems like yeah, I mentioned this in the when I was meeting with Joel, is that people think that interest rates are coming to save the party. And you mentioned, and I've noticed over time that the Fed funds rate, which
Right.
is talked about, they're going to cut it, et cetera,
Yep.
and how many times, it doesn't necessarily result if they cut the Fed funds rate in a reduction in mortgage rates. And one thing that Joel pointed out last time is he was like, that last cut was already baked in to mortgage
Right.
rates. And so the cut happened. Well, we all knew it was coming. It was
Right.
well broadcast. And when
Yep.
it came, mortgage rates ticked up a little bit.
Right.
Yeah. How do you think about that or the association or disassociation between, say, the Fed funds rate that we hear about on the news that the Fed's cutting versus what it might cost people to get a mortgage or a loan from Kiavi?
Yeah. Thankfully, again, the conventional rates they're long term, right? So they're 30-year fixed typically, 30-year amortizations. So you're allowing a consumer to lock into that property for that length of time. So being as a conventional lender or somebody that's providing the capital, you want to make sure that the money that you're putting in is being received back that is sort of market appropriate. And so on the shorter term side, like with Kiavi, we're giving 12-month loans, right? They're already market appropriate because they're anywhere between at a low, let's call it 9.5, maybe up to 11 or 12, depending upon experience. But that's being paid back in 12 months. So it's very easy for that type of loan to, at some point, be market adjusted because it's such a short-term finance deal. If there's a need to ever do that, then it's like, okay, in 6 months or in 12 months, that market can adjust. Whereas on a 30-year fix, even though statistically most homeowners will finance out of the rate that they're in within 7 to 8 years of acquiring the property. That's just data. It
Right,
doesn't mean that everybody does that. It just means
right.
a high number of people tend to finance out of their initial loan. My parents didn't, back in the old days, but you know, people that refinanced in 2020 or 2021, I can guarantee you they have no desire to finance out of that because interest rates are at least double what they were. So they're absolutely going to, that's the struggle, right? So they might be in a house in a rate that's not appropriate for them, like the house. They want to move up and they're going, oh my gosh, I'm going to go from 3.25 to 6.5 or 7. And they have a bigger house and a bigger payment. Like the last thing they want to do is do that. right? And so that's why that initial move up buyer isn't doing that. But from a conventional rate standpoint, there's nothing driving where interest rates should be. Okay, conventional lenders are borrowing at a certain level, and their borrowing funds are at a level where there has to be some level of compensation, lack of a better word, that a lender needs to get to provide that financing to a consumer. And the Fed fund rate is more from a banking standpoint and to keep them afloat, but it's never going to be a 1-to-1 ratio as it relates to that. It's more like where bonds are going or where the 10-year note is going. So not sure that resonates or helps with people, but that's why there's a disconnect. It's not Fed funds goes to banks, banks lends to consumer. It's the conventional rates are more driven by the activity around where the 10-year, where the bonds are being invested in, et cetera. Because when a lender lends money, everybody has a certain amount of money to lend, right? And then what ends up happening is the lenders that have those monies, they securitize those into what is considered a bond, right? And then you have investors, could be consumers, insurance companies, et cetera, that buy those bonds, right? And so their expectation when they're buying those bonds is there's risk involved, high or low. And so as that risk is assessed, the expectation of paying for that risk is assessed on a very regular basis. And so the price of the mortgage needs to be appropriate to what people are willing to pay for those bonds. If people expect bonds to have higher prices, then those rates have to be higher for them to get that, right? Or those lenders would run out of money. And then the performance on those bonds is what enables the lender to continue to lend.
Yeah, yeah, no. I do have one. This is completely off the wall. I was just thinking about it as you were speaking, that thinking about the year ahead, there's been a couple of crazy ideas that were proposed.
Yeah.
This isn't necessarily going to affect the Kiavi, but you as a lender, I'm just curious what you think. One
Sure.
was the idea of a 50-year mortgage, and
Right.
the other was the idea of portability of loans. So, because the problem that they were trying to fix, as you were talking about, was people have these, say, a 2.5% loan from a few
Right.
years ago, and
Yep.
they talk about folks being locked into their
Right.
loans. They can't move because it would cost too much, and the new financing would be so expensive. To me, these are political ideas. They're not financial ideas. Meaning, I don't think the world needs a 50-year mortgage. I don't think we need that. And the other thing is, I think portability is an undoable idea. But yet we like, because loans are attached to an asset,
Right.
house,
Mhm.
and a borrower,
Right.
their ability to repay.
Right.
The idea that that borrower could port that loan over to a different property
Right.
seems to me to be it almost seems like we're talking about kind of silly things that make people feel like we're doing something.
Sure. I
Do you
agree with
agree or
both.
have thoughts
Right.
on those things?
Well, yeah, I mean, I think the idea of a 30-year fixed mortgage, I think came about in I want to say 60s or early 70s, right? When Fannie Mae and Freddie Mac were
Yeah, yeah, yeah.
kind of created. And so at that time, it was probably considered, oh my gosh, right? And so because some part you have to go, yeah, just because people are living longer doesn't mean somebody's mortgage needs to be longer. So the thing that I think people tend to miss is, they hear this because a 40-year mortgage already exists and it's almost never used. So look at it from a short-term financing standpoint. A 12-month loan might be priced at 9%, but a 24-month loan is priced at 10. So there's a 100 basis point difference in a short-term loan that's only 12 months longer. So when you're looking at a 30-year fixed mortgage that's priced at, let's use round numbers, 5. Do you think a 50-year mortgage is going to be priced at 5? Of course not. It's going to be priced significantly higher. So your payment is going to be amortized over a longer period of time, but your interest rate's going to be higher. The amount of
Yeah.
time you pay interest is going to be longer, right? So right now on a 30-year fixed mortgage, you probably are not making any really earnest reduction in principal for the first 3 to 4 years. You're making some. It's not going to feel that way.
Right.
So on a 40-year mortgage, that extends that out. On a 50-year mortgage, it's going to extend that out further. And so let's say if you were looking to sell that property in 5, 6, 7 years and it was on a 50-year mortgage, you're going to have no equity creation through principal reduction.
Right.
It's going to
Yeah.
all have to be in equity growth, right? You're going to be very frustrated on that. Plus the payment difference. I think I looked at somebody doing a $200,000 mortgage versus a 30-year and a 50-year. The payment difference was $27. Now, is that lower? You betcha, right? But is it so significant that it would make you get that property? Probably not, right? Just because of the entire interest that you're going to have to be paying on that. So I think there has to be, and then portability is a non-starter just because how people look at securitizing mortgages, to your point, they look at the operator, the vetting of that operator, credit, income, assets, et cetera. They look at the property. Property location is critical. Some lenders don't lend in certain areas, or they might lend it lower, like if and like rural areas, right? So the larger a buyer pool, the better it is for a lender, right? So if they have to take back a property and they have a large buyer pool, they're probably going to get paid back at or above the level they need to. When you
Right.
start putting a property into areas where there's fewer buyers, there might have to be significantly larger concessions to get rid of the property, right? And so similarly, from a portability standpoint, if you have a property that's in a highly desirable area and you take that mortgage and move to a less desirable area, then that affects the risk associated with that particular mortgage to the servicer or that lender. And so requalification would have to take place, but the whole point of portability is to hopefully eliminate that. So that's why that I think portability is really a non-starter relative to mortgages. If somebody figures it out, right? Maybe there's like zip code restrictions, area restrictions that they would put in that would be kind of cool, but there's going to have to be some renewal or requalification that
Right.
could have or would have to take place for that
That's what I was
portability to
thinking.
make sense for
I was
sure.
thinking it almost would end up being a different no, because like you said, well, I'm going to port this one,
Yeah.
but it's a different property and this could change
Yeah. Portability really
terms.
only comes into play when interest rate difference is significant,
Yeah.
right? So it really is the only people that want portability are people that refinanced or financed a property in 2019 through 2022.
Right.
Before
Yeah.
that, they could care less. After that, market's already caught up. It really is that window of people in that 3 year period.
Yeah. Yeah. Yeah.
And that's a significant number of people, right? But it might not be enough to have Congress address this or businesses address this. And it would have to be Congress because so much of the business is actually sold to Fannie Mae and Freddie Mac, which are still, kind of still, under the government right now. They're not their own entities yet.
Yeah. Yeah. All right. Well, I tell you, this went longer than I expected, but I love having you on because if people want to learn about this topic, they could watch a 30-second TikTok or they could watch an hour and 15-minute long
There you go.
video with an expert. And I think there's a few people, like I bet there's a few people that make it to the end of this. And those people are the people that are really have a thirst for knowledge and they're growing their their
Yeah.
skills and their intellect around this space. It's just really amazing to have this much time to spend with you. I have a huge amount of respect for you. You've got Kiavi's definitely as these guys grow their businesses and they look for to really scale,
Yep.
Kiavi's a fantastic partner to accomplish that. And yeah, the hard money idea scare you away. The guys that I know that have built multi-million dollar portfolios have done it
Yeah.
with leverage.
Yeah,
They've
for sure.
done it by borrowing smart. And
It keeps your cash where you want it, which is in your bank for either safety, other opportunities, et cetera. So I think it's the most successful operators in our space absolutely leverage through institutional lenders, banks, et cetera. They use other people's money for sure.
yep. Well, and of course, these folks can go to Kiavi.com, learn
Yep.
more,
Yeah.
apply, all that kind of good stuff.
Yep.
I'll just kind of wrap up our show today by reminding everyone that they can go to cashoffermasterclass.com, get our calculator that we used when we analyze houses. And of course, you can search Cash Offer Masterclass on YouTube or on Google, and you will find our content because there's only one Cash Offer Masterclass here. And with that, Ray, I'm just going to say thank you so much. We'll wrap it up. And do you have any closing comments for the group that stuck with us till the end?
Yeah, I appreciate that you put just different topics out there for folks, right? I mean, you're giving it away. I think education is a big piece. You've eliminated the issue that people have, which is cost, right? Just I want to find good content, et cetera, whether they found this to be good or not. But your other episodes are absolutely phenomenal. So really appreciate everybody kind of sticking in, and hopefully you can maybe do it at 150% or 175% speed and get to the end sooner.
There you go. All right. With that, I'm going to say
All right.
adios,
Yep.
my friends. We'll
Alrighty.
see you on the next episode. Thank you so much, Ray.
Alrighty. Take care, guys.
Good